Hi everyone, welcome back to Corporate Decoder, the place where we try to figure out if the company's numbers are really as good as they sound. Today we're diving into DXC Technology's latest quarterly report, and let's just say there are some interesting moves being made, not just in their business, but also in how they tell us about it. DXC Technology is a big IT services company helping other businesses with their digital needs. They've recently changed how they report their business, now focusing on three main areas: consulting and engineering services, global infrastructure services, and insurance services. This is important because it shows how management sees the company is run and measured. Looking at their income statement for the 3 months ending June 30, 2025, we see revenues were around $3.6 billion. That's a small drop from about $3.24 billion in the same period last year. It might not sound like much, but it's a pattern we need to watch. Now, what's really jumping out is their selling, general and administrative costs. They went up quite a bit from $301 million last year to $394 million. This year, a jump of over 30%, they say. This is because they moved some business development costs to this category and are investing more in marketing. But a 30% increase in these costs while revenue is going down, that's a red flag for efficiency. And as a result of these costs, net income attributable to DXC common stockholders took a hit. It dropped from $26 million last year to just $16 million this year. That's a pretty significant fall, and it definitely impacts what's left for shareholders. Basic earnings per share, or how much profit is attributed to each share of stock, also went down. It was 14 cents last year, and now it's only 9 cents. This means each share is earning less profit than before. The company also has a significant accumulated other comprehensive loss, which was around $762 million at the start of the year, and grew to $81 million by the end of June. This often relates to things like foreign currency adjustments and pension plan changes, showing unrealized losses that are impacting the total equity picture. Let's talk about cash. DXC generated $186 million from operations in the most recent quarter, down from $238 million a year ago. While they still made money from running the business, it's less than before, which can tighten up their ability to invest or pay down debt. On the investing side, they spent $77 million, a lot less than the $18.8 million they spent last year. This is mainly because they cut back on buying and developing software, and also reduced capital expenditures. It suggests they're being more cautious with how they spend money on long-term assets. Financing activities saw a big shift too. Last year they brought in cash through financing, but this year they used $110 million. This is mainly because they didn't borrow as much and they spent more on repurchasing their own stock. Speaking of debt, their total debt has actually grown. It stands at over $4 billion, up from around $3.87 billion at the start of the year. While a good portion of this is long-term, any increase in debt needs careful watching, especially if their cash generation continues to fall. DXC continues to spend on restructuring. They had $37 million in restructuring costs for the quarter, a slight decrease from last year. This signals they are still trying to streamline their operations, which can be good for long-term efficiency, but adds costs in the short term. There's a significant ongoing legal matter concerning securities litigation, while they mention reaching an agreement in principle to resolve claims, and that insurance carriers will cover their share of the settlement. The exact final cost remains a bit uncertain. This can always be a major risk for companies. Scrollsys litigation, CCS litigation, is also a big story. DXC won a significant jury award in a trade secrets case against TCS. However, TCS is appealing, so the final outcome and the cash DXC actually receives are still to be determined. It's a potential upside, but not guaranteed yet. Scroll ranges by geography show the US market is still their biggest, but it's seeing a decline. Other regions like the UK and other Europe are showing slight growth, which is a positive sign, but not enough to offset the overall revenue drop. Their cost of services, which is basically the cost to deliver their IT services, went down by about 5.5%. This is likely due to lower revenue and cost-cutting efforts, which is good, but it's also partly because they've shifted some expenses to SG&A. Scroll non-GAAP financial measure, non-GAAP financial measure, GAAP financial measures, tap for now, DXC. Like many companies, uses non-GAAP financial measures to present their performance. They exclude things like restructuring costs, the amortization of acquired intangible assets, and impairment losses. They believe this gives a clearer picture of their ongoing operations. However, it's important to remember that these are adjustments, and while they can be useful for understanding the core business, they sometimes mask the total cost of doing business. Scroll adjusted EBIT, for example, their adjusted EBIT, which excludes these special items, is down about 3.6%. This adjusted measure is often used to show a smoother performance trend, but the fact that even this adjusted number is down is something to note. Scroll diluted EPS. Their diluted earnings per share is 9 cents, down from 14 cents a year ago. If we look at their adjusted diluted EPS, it's 68 cents, down from 75 cents. So even when you smooth out the numbers, earnings per share are declining. Scroll cash and cash equivalents at the end of period. TFC ended the quarter with about $1.8 billion in cash. That sounds like a lot, but a good chunk of it is held overseas. While they say it's generally not subject to US taxes upon repatriation, there are still some limitations and potential tax consequences on some of that cash, meaning not all of it is readily available for whatever they might want to do. Scroll to liquidity of $5 Icon and $0. Their total liquidity is around $5 billion, which includes cash and their available credit line. This means they have access to funds, but how they manage their debt and operations will be key. So what's my take on DXC Technology's performance? Well, the declining revenues and the significant increase in SG&A expenses are definitely concerns. While they mention strategic shifts and cost-saving initiatives, the bottom line shows a weaker performance compared to last year. The legal battles, especially the TCS case, offer potential upside, but add a layer of unpredictability. DXC seems to be in a period of transition, trying to streamline and reposition itself, but these changes are costly and impacting profitability. They have a decent amount of cash and liquidity, which helps, but the trend to navigate a tough market while also restructuring, which is a challenging balancing act. We'll need to see if their new segment structure and cost controls truly pay off in future quarters. Alright, that's our breakdown of DXC's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community in the description below for more engaging discussions. Thanks for watching. See you next time.